Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're taking a look at BlackBerry.
And if you find our talks useful, please take a moment to subscribe, like, and comment underneath. It really does help us keep these conversations going.
So we have to start with the big picture here. You have to completely forget the old company, the handsets.
Right. That's ancient history.
It is. This is a pure play software business now. It's built around two really distinct segments.
Yeah.
You have QNX, which is their Internet of Things, or IoT business.
Mostly for automotive, right. The embedded systems in cars.
Exactly. That's the big one. And then you have secure communications, which is their classic cybersecurity management business. The key thing for you to know is that the old legacy licensing revenue is basically zero now, just noise.
And that structural change is so important because it leads us right to, well, the most surprising part of this whole story, the profitability.
Yeah, the recent Q3 performance really shows the pivot is starting to pay off.
Starting to. It looks like it's really working.
Well, yeah. I mean, it's not just working. It's validating the entire strategy. Total revenue hit $141.8 million.
Which was above their own guidance.
Above the top end of their guidance even, they're delivering. But, here's where it gets really interesting. It's the swing to actual profitability.
Tell us about that swing.
Okay, so they reported GAAP net income of $13.7 million. And for anyone tracking this, GAAP is the gold standard. It means, real profit after everything's accounted for.
And this is after years of losses.
A huge swing from a loss in the prior year. This is the strongest GAAP profitability they've seen in about 4 years. On an adjusted basis, it's even higher, $26.8 million.
Seeing positive GAAP profit for a company that's been in what feels like perpetual restructuring mode, that is a massive signal. What does it say about their operations now?
It says the whole cost structure has been re-engineered. They've got an adjusted operating margin of 18%, and their adjusted EBITDA margin hit 20%.
20%.
Yeah. And for a software company that's scaling, that concerns that every new dollar of revenue just flows much more efficiently to the bottom line. They've made the switch from that old high-overhead hardware model to a high-margin software one.
And you can see where that profit's coming from when you break down the segments. QNX, the growth piece, hit a new record.
It did. QNX brought in $68.7 million in revenue. That's up 10% year over year. So it confirms their main markets, automotive, industrial, medical. They're all still adopting and ramping up this tech.
So that 10% growth is solid, but it seems like it's the other business, secure communications, it's kind of the steady hand financing all this.
Absolutely.
Yeah.
Secure Communications did $67 million, so it's basically the same size as QNX right now, and it also beat its guidance.
And it's profitable.
Very. It brought in $17.3 million in adjusted EBITDA. That's a 26% margin.
Yeah.
So think of it as this super profitable, really sticky cash generator that's just funding all the investment into QNX.
Okay, so the bullish case is really built on these three things then. You've got sequential growth, you have positive GAAP earnings, and you have those high 70s gross margins that you always see in software.
Right. It's not just a cost-cutting story anymore. This is a business that's turning into what you might call an early-stage profitable compounder.
But hold on, the foundation has to be solid for that to work. If revenue is still a bit sluggish overall, how stable is the financial footing they're standing on?
Very stable. Their liquidity is strong. They're holding $378 million in cash and investments.
And that's up from the last quarter.
Up sequentially, yeah. And that's mainly because they generated positive operating cash flow, $17.9 million in Q3.
So no worries about liquidity. They're funding their own growth.
Precisely. They're in a net cash position, meaning cash on hand covers their long-term debt. The ratios, current and quick, are solid at 2.2. They have flexibility.
And management seems confident because they actually raised their guidance for the full year.
They did. They bumped up the midpoint for full-year revenue. And more importantly, they guided to $35 to $40 million in full-year operating cash flow. That's management saying, look, we are a cash flow positive business now.
Let's go back to that idea of operating leverage because that's the real payoff. Analysts are seeing, 6% revenue growth, but 30% earnings growth? How does that work?
It all comes down to software economics. Think about QNX. All the heavy lifting, the R&D, the certifications, writing the code, that's a huge fixed cost.
Right. It costs the same whether you sell one copy or a million.
Exactly. So your first $100 million in sales goes to pay for the engineers, the buildings, all of that. But once those fixed costs are covered, That $101 million in revenue,
Hmm.
almost all of it drops straight to the bottom line as profit.
That's operating leverage.
That's it. And analysts believe BlackBerry has just crossed that inflection point. So now even modest revenue growth, say 6%, will create this magnified, steep earnings growth, that 30% number, as they scale up.
That explains the long-term case. But for now, where's all this cash going? Any shareholder returns?
Not right now. No big buybacks or dividends. They're pouring it all back into the core businesses, QNX and Secure Communications, to expand margins.
Which is probably the right move.
And, having that clean balance sheet and cash flow also positions them as a potential buyer in their niche instead of having to sell shares to raise money. That flexibility is huge.
Okay, so now we get to the heart of it, the moat. For QNX to be this big growth engine, it has to be defensible. Why can't a big tech company just come in and build the same thing?
This is the strongest part of the whole thesis, and it's all about what QNX is. It's a real-time operating system, an RTOS,
Oh, what?
a real-time OS. It's the foundational software brain that guarantees things happen reliably within milliseconds every single time.
Give me an example of why real-time is so important.
Think about the safety systems in your car. If the camera sees an obstacle, the RTOS has to process that data and hit the brakes within, say, 10 milliseconds. Guaranteed. If it's even a little late, the car crashes.
Okay, got it. It's mission critical.
It's life or death critical, and that reliability is proven through safety certifications, like ISO 262622 for auto. Getting that certification is a massive barrier to entry. It takes years of audits and testing.
So once an automaker picks QNX for a new car platform, they're basically locked in.
They're not swapping it out. That single design win becomes a multi-year stream of high-margin royalties for the entire, 7 to 10-year life of that car model.
And it seems like they're trying to widen that moat with this QNX Everywhere initiative.
It's a really smart low-cost play. The sources say they've given out over 12,000 free non-commercial licenses. They've got agreements with 80 universities in India, reaching over 6,000 students.
That's a huge pipeline of future engineers.
It is. These students are building robots, they're building race cars, all using QNX. They're getting comfortable with it. So when they graduate and start working on commercial projects, what tool do you think they're going to reach for?
The one they already know.
It's a classic ecosystem trap.
Let's switch over to secure communications. It's the cash cow, but is it just as defensible?
It's highly resilient, just in a different way. This is the trusted choice for governments, for big regulated industries. The focus is on sovereign-grade secure communications.
And the numbers back that up.
Their annual recurring revenue, ARR, is at $216 million. That shows scale. And their dollar-based net retention, the DDNRR, is at 92%.
Which is pretty sticky.
It's solid. It means they're keeping 92 cents of every dollar from their existing customers year after year. There's some churn, but that core base is locked in on long-term high-security contracts.
Okay, so here's the puzzle. We have these improving fundamentals, cash flow, clear moats. But the stock price is down 30–40% over the last year. What's going on?
The market is just lagging the reality of the business. The price action has been weak, no question, though it's seen a bit of a bounce lately. But here's the key detail. If you've held the stock for 3 years, you're still up.
So this is more of a short-term sentiment issue, not a long-term breakdown?
That's what it looks like.
Yeah.
And the valuation models are starting to catch on. A recent analysis put fair value at around $6.15 Canadian versus a current price in the mid-fives. So, maybe 10–11% undervalued.
And analyst targets?
The average 12-month target implies maybe 25% upside from current levels. Basically, the downside risk from here seems pretty limited if they keep executing.
So analysts are sort of seeing this sub-$5 range as a buying opportunity.
An accumulation zone, yeah.
Yeah.
It's a classic contrarian setup. You've got weak price action clashing with strengthening fundamentals. That's usually a sign that a bottom is forming.
Let's dig into that sentiment, though, because even with the good earnings report and the raised guidance, most analysts are still on the fence, right? A neutral or hold rating. Why?
The skepticism is really about two things. First, can QNX growth actually accelerate past that 10% rate? The market wants to see proof of 15, maybe 20% growth. And second, there's some concern about one-time items, occasionally masking the true organic growth picture.
And we have to talk about the big non-operational risk. There have been some very serious allegations about a toxic company culture, including claims against the CEO, which the company denies.
Yes, and that is absolutely not trivial. That kind of issue weighs very heavily on management's credibility and the company's whole ESG profile. It's a significant overhang on the stock.
So how do you factor that in?
Well, from a purely financial risk perspective,
Mm-hmm.
you could argue that this bad news is already priced in, given how much the stock has fallen. It's a serious reputational problem for sure, but it hasn't directly affected the QNX technology or their customer contracts. But it definitely adds long-term risk around management stability.
Okay, and looking forward, what are the key dates or events for people to watch over the next, say, 3 to 6 months?
The big one is the next earnings report, Q4, which should be in late March. All eyes will be on one metric, QNX revenue growth. Can it stay at or accelerate above that 10%?
Anything else?
Yeah, you'll want to watch for news from any of the big auto or IoT conferences. A new partnership announcement, a big design win with a major car maker, that could be a serious near-term catalyst.
And then there's always the M&A speculation.
Always. And it's not totally unfounded. You have a company with two very distinct, valuable software businesses and a pile of cash. It makes them a logical target for a bigger player that wants to get into embedded safety systems or high-grade security.
So let's bring it all together. What is the final investment thesis here, based on all the data?
The data suggests BlackBerry is a mispriced, profitable software company. The facts, the GAAP earnings, the cash flow, the record QNX revenue, they all imply that market sentiment is way behind the curve of the fundamentals. This offers, an asymmetric upside. It's a contrarian, cash-generating turnaround story with real structural moats.
And what's the right time frame to think about this?
This isn't a quick flip. It's a multi-year hold, probably 12 to 24 months, to really see the payoff from the software transition and let QNX fully scale up.
That's very clear. Okay, let's leave our listeners with a final provocative thought to chew on.
Right. So the company has $378 million in cash and these two distinct, valuable software businesses. Think about how that setup makes them attractive, not just for their own growth, but as a target. A major player could buy them and easily split them up or integrate them. That optionality, that potential breakup value is a key wealth-building element that the current cautious stock price might not be reflecting at all.